Qualcomm shares sliding this morning after the chipmaker posted fourth quarter earnings and issued disappointing outlook as weak smartphone demand hit its chip business. Joining us now for more on Qualcomm is KeyBanc Capital Markets equity research analyst John Vinh. John, when you think about where the concerns are, obviously a weak outlook, drawdown in inventory, sort of concerns about where that demand is going, weighing on the stock today, but you still have a price target that is well above where it's trading. How much of the declines we're seeing you think is justified given the numbers?
I think some of the declines are certainly justified, right? Their guidance was much worse than expected. I think it was pretty clear and obvious that, sell-through of smartphones, particularly in Android in the China regions and Europe, has been particularly weak. But their guidance actually came in, a lot worse than people had expected at this point.
And what does that tell you about where things are headed? I mean, we've heard these warnings from so many of these chip makers. How much of what we heard yesterday is Qualcomm specific? How much of this is about a broader drawdown that we're seeing that's likely to last?
I think this is part of a broader drawdown that we're seeing within kind of consumer applications. Anything that touches the consumers, PCs, smartphones, consumer electronics has been extremely weak. Qualcomm was issues were compounded by the fact that not only sell-through and end demand was weak, but they were also being impacted by kind of a broader inventory correction. What happened during the pandemic over the last couple of years in response to the chip shortages is that customers built buffer inventory to basically guarantee supply. But now that end demand is starting to soften and supply is starting to normalize, you're seeing a lot of these customers destock to get back to kind of pre-pandemic normalized inventory levels. And that's really compounding kind of the near-term issues with Qualcomm here.
In addition to sort of the market demand, which obviously, sort of has a significant impact on the business, you've also got chip makers overall being caught right in the middle of geopolitics, the export controls that the Biden administration has implemented, so that there's essentially a line that's cut off between the U.S. and China, at least in advanced chips. Where do you think Qualcomm is positioned in all of that? And how much weight do you put on that in terms of the headwinds the company is likely to face?
I think the impact by these latest BIS export restrictions really don't have a big impact on Qualcomm. The latest restrictions are really targeting kind of advanced computing, targeting kind of data center workloads around machine learning and AI. Qualcomm, plays more in that consumer space, right? They obviously have an emerging business within automotive. They do have an IoT space, but the latest round of restrictions really don't have a material impact on Qualcomm in our view.
And finally, you still have an overweight rating on the stock, although you did cut your price target from $170 to $150 a share. Looking at where the stock is today, that's still more upside. What do you think is going to be the catalyst that gets you there?
I see a couple things, right? So I think in this sort of environment, the investor appetite is there's an appetite for stocks that have kind of reset and de-risked kind of forward expectations, right? There's a handful of companies in semis that still have not seen kind of the weakness yet. Estimates are still at historical highs. But here you've had kind of two significant cuts to forward expectations. So we think the estimates for going forward are largely de-risked. The second thing is the company has a clear line of sight to when inventories likely are going to bottom. They've quantified the inventory correction at roughly $2 billion a quarter for the next 2 quarters, but it looks like we're going to bottom in the March quarter, and at which point you get back to kind of normalized run rates. And then the last thing I would point out is much of the weakness that they're seeing right now are being caused by the lockdowns in China. At some point, these rolling lockdowns have to cease, and we think that's going to happen at some point in the first half of 2023. And we expect there to be significant pent-up demand by the average consumer in China coming out of that.